For most people, the IMF is just another headline factory. A report drops, numbers fly around, and life goes on. But every once in a while, buried inside those spreadsheets, there's a message that feels different, less academic, more unsettling. The IMF's outlook for 2026 is one of those moments. Not because it predicts a dramatic crash tomorrow morning, not because it's screaming recession in bold red letters, but because of what it quietly assumes about how the world will work from here on out. The IMF is essentially saying this: the world economy isn't broken, but the version of normal we grew up with isn't coming back. For the US, the UK, Australia, and most advanced economies, 2026 is shaping up to be a year where growth exists, jobs exist, markets exist, but comfort doesn't. Let's start with the headline number everyone loves to quote: global growth. On paper, the IMF expects the world economy to keep expanding through 2026. No collapse, no global depression. But here's the catch. This growth is weaker, uneven, and far more fragile than what we saw before 2020. In plain English, the engine is still running, but it's lost horsepower. For countries like the United States, growth is projected to slow, not stop, just slow enough to feel uncomfortable. Businesses won't be collapsing en masse, but they won't be aggressively hiring either. Wage growth cools, productivity disappoints. And suddenly, the American consumer, the backbone of the global economy, starts pulling back. Not dramatically, quietly. In the UK, the story is even tighter. Years of weak productivity, high energy costs, and post-Brexit trade friction have left the economy unusually sensitive. The IMF isn't predicting disaster, but it is suggesting Britain will be walking a narrow ledge where even small policy mistakes could tip growth from weak to flat. Australia, meanwhile, sits in a strange middle ground. Strong population growth, heavy exposure to China, and a housing market that refuses to cool all collide at once. The IMF's outlook suggests Australia keeps growing, but at the cost of rising household pressure. Mortgages stay expensive, living costs stay elevated, and economic strength starts to feel more like endurance than prosperity. Now, here's where the IMF's 2026 outlook really turns uncomfortable. Inflation. Yes, inflation is cooling. Central banks want you to believe the worst is over, and technically, they're right. The IMF expects inflation to be lower in 2026 than it was during the post-pandemic spike. But lower doesn't mean low. The report makes something painfully clear. Inflation is likely to settle above pre-2020 levels for a long time. That means higher prices aren't a temporary phase, they're the new baseline. For households, this changes everything. Your salary might rise, the economy might grow, but the gap between what you earn and what life costs doesn't fully heal. Groceries remain expensive, insurance stays high, and this is where frustration sets in, because the charts say the economy is improving, but daily life doesn't feel like it. If you're watching this and thinking, that already feels familiar, you're not wrong. The IMF is essentially projecting today's emotional economy into 2026, stable but strained, functional but exhausting. Before we go further, if you value breakdowns like this that go beyond headlines and actually explain what these reports mean for real people, make sure you're subscribed. These conversations matter, especially heading into the next few years. Now let's talk about debt, because this is the part most people skip, and it might be the most important. By 2026, global debt levels are expected to remain historically high. Governments borrowed heavily to survive the pandemic, and there's no clean way back down. The IMF isn't panicking about default, but it is warning that high debt limits flexibility. In simple terms, when the next crisis hits, governments won't have the same room to respond. For the US, this means higher interest payments quietly eating into federal budgets. For the UK, it means tough trade-offs between public services and fiscal credibility. For Australia, it raises questions about how much more pressure households can absorb before something cracks. And all of this sits under one giant assumption the IMF makes without saying it out loud. The world will avoid major shocks. No major wars expanding. No financial system accidents. No sudden energy crises. That's a bold assumption. Because if 2026 teaches us anything, it's that the global economy is no longer built for surprises. And that's where this outlook starts to feel less like a forecast and more like a warning. Quietly builds its entire forecast on a fragile foundation that the world muddles through. No dramatic collapses, no sudden system failures, just a slow grind forward. But history doesn't usually move in straight lines. It lurches. And the IMF knows this. That's why the language shifts when it talks about risks. Geopolitics, trade fragmentation, climate shocks, financial market stress. These aren't side notes. They're pressure points. Take global trade. The IMF expects trade growth to remain weaker than it was before 2020. China and its partners on another. Supply chains that were once optimized for efficiency are now redesigned for security. That sounds smart until you realize it's expensive. For American, British, and Australian consumers, this means higher costs baked permanently into everyday goods. You don't see it as a tariff or a headline. You see it in prices that just don't come down. And businesses feel it too. Companies are investing less aggressively, not because they're failing, but because uncertainty kills confidence. When CEOs can't predict trade rules, energy costs, or political stability, they sit on cash. Expansion slows, hiring slows, innovation slows. This is how an economy survives but doesn't thrive. Now, layer on interest rates. By 2026, the IMF expects rates to be lower than today, but not anywhere near the ultra-cheap money era people quietly hope will return. Central banks are done rescuing markets at every wobble. Inflation taught them a painful lesson. Money will have a cost again. That's a problem for a world addicted to cheap borrowing. Households refinancing mortgages won't feel relief, they'll feel adjustment. Governments rolling over debt will feel pressure. And asset prices, especially housing and stocks, stop feeling like guaranteed upward escalators. This doesn't mean a crash. It means restraint. And restraint is emotionally harder than crisis because there's no single moment to blame. The IMF's outlook suggests inequality continues to widen as well. Asset owners adapt, wage earners struggle. Younger generations face higher barriers to entry into housing, into wealth, into security. The social tension this creates isn't theoretical anymore. It's already visible in elections, protests, and cultural divides across the US, UK, and Australia. Economic stress doesn't stay economic for long. It turns political. And that's where 2026 becomes dangerous. Because governments facing slow growth, high debt, and frustrated voters often reach for short-term fixes, spending promises, trade barriers, populist economics. The IMF doesn't say this directly, but its numbers leave very little room for mistakes. One wrong move, and slow growth becomes stagnation. One shock, and fragile confidence breaks. And yet, this is not a hopeless picture. The IMF isn't forecasting collapse. It's describing a transition, a world moving from speed to stability, from abundance to constraint. The problem is that most people were never told this transition was happening. We're still measuring success using old expectations. We expect prices to fall back. We expect growth to feel exciting again. We expect life to get easier. The IMF's 2026 outlook quietly suggests something else. Life may get more stable but not more comfortable. That's a hard truth to swallow. But understanding it matters because individuals, investors, and even governments who adapt early tend to fare better. Resilience beats optimism in slow growth world. And here's the final, uncomfortable takeaway. If the IMF is right, the biggest economic risk in 2026 won't be recession. It will be complacency. Believing that no crisis means everything's fine. Believing that survival equals success. Believing that stability means safety. History says otherwise. The world economy doesn't usually break when things are terrible. It breaks when pressure builds quietly and nobody adjusts. That's why this outlook matters. Not because it's shocking on the surface, but because it forces a question most people haven't asked yet. What does a good economy even look like anymore? If this video helped you see the global economy more clearly, and not just through headlines, make sure to like, subscribe, and share it with someone who still thinks everything goes back to normal soon. Because the future isn't collapsing. It's changing. And the people who understand that early are the ones who stay ahead.